In the pantheon of high-growth tech names, Netflix has long stood as a totem of visionary execution. It reshaped media consumption, pioneered streaming at scale, and built a global brand on the back of relentless subscriber expansion. But in Q1 of this year, the narrative buckled. Netflix reported subscriber additions significantly below expectations, sending its stock tumbling despite rising revenues, sustained earnings, and a raft of upcoming initiatives, including an ad-supported tier and aggressive password sharing enforcement. The market's violent reaction reveals something deeper, a reckoning with the limitations of growth-centric valuation models that over-rely on user KPIs at the expense of monetization and margin. This video explores what the Netflix miss tells us about the fragile scaffolding beneath many growth stock valuations. We examine how expectations around user growth are embedded into discounted cash flow models, how terminal value assumptions become dangerously reflexive, and why investors must be wary of KPI myopia. Ultimately, Netflix's stumble provides a cautionary tale for analysts. Narratives built on non-financial metrics can propel valuations skyward, but they can just as swiftly collapse when growth falters. Netflix's trajectory has always been about scale. From its DVD by mail origins to becoming a global streaming behemoth, its investment thesis rested on a simple premise: more users equals more value. This philosophy drove massive investments in original content, aggressive international expansion, and a tolerance, if not preference, for razor-thin margins in exchange for rapid top-line growth. Subscriber growth was the KPI of choice, with quarter-on-quarter net additions becoming the focal point of investor calls. Management leaned into this by rarely emphasizing profitability, instead promising that scale would eventually bring leverage. For a long time, this approach worked. In 2018, Netflix added 28 million global subscribers. In 2020, amid COVID lockdowns, that figure reached over 36 million. Valuations soared as discounted cash flow models were stretched to accommodate ever-increasing user forecasts. In Q1 2025, Netflix reported 2.3 million net new subscribers, far below the expected 5 million. This miss came despite a heavy content slate, new season releases of flagship shows, and sustained ad tier rollouts. Immediately, the stock fell nearly 15%. Curiously, revenue rose 6% year over year, and net income beat consensus. So, why the dramatic sell-off? In the Netflix valuation framework, subscribers serve as more than just a metric, they serve as the pivot. Market expectations had priced in accelerating user growth on the back of new monetization strategies. The shortfall broke that narrative. Importantly, the reaction was not proportional to changes in revenue or earnings. It was an implicit re-rating of terminal value. Investors revised their long-term assumptions, realizing that user growth might be plateauing. And when growth slows, particularly in a stock trading at elevated multiples, valuations compress violently. If the equity value relies on unrealized future scale efficiencies, it can experience rapid and severe fluctuations. Understand why the market cared so much about a few million users? We must unpack the valuation of growth stocks. Like many high-growth tech firms, Netflix's intrinsic value comes not from current cash flows, but from those projected 5 and 10 years out, captured in the terminal value of a DCF model. Subscriber growth feeds directly into revenue projections, which feed into EBITDA margins and cash flows. A miss in one quarter often prompts investors to reassess the entire trajectory. Scenario modeling makes this stark. Base case, 5% annual subscriber growth over 10 years, terminal EBITDA of $20 billion. Revised case, 2% annual growth, terminal EBITDA of $13 billion. Even modest changes in growth rates can result in 20-30% shifts in present value under realistic discount rates. If equity value is riding on future scale efficiencies that never materialize, the re-rating can be swift and brutal. This is the Achilles heel of priced for perfection stocks. They leave no room for disappointment. Subscriber count is just one example of the broader issue: over-reliance on non-financial KPIs. Metrics like monthly active users, churn, engagement time, and customer acquisition cost are useful indicators, but they are not proxies for value creation. Netflix's Q1 made that clear. The industry has many precedents. Despite the collapse of hardware margins, Peloton traded at nosebleed multiples, driven by its connected fitness subscribers. Snapchat reported record engagement hours while struggling to monetize effectively. Meta's pivot to the metaverse temporarily dislocated its valuation as KPIs focused on future user behaviors, divorced from near-term profit. For Netflix, average revenue per user, ARPU, is arguably more telling. In Q1, ARPU grew modestly, suggesting better monetization. Yet, because ARPU is often ignored in favor of user count, this positive was overlooked. The market's model was wired to reward user growth, not efficiency gains. Compounding the issue is an evolving competitive landscape. The streaming wars are now in their attritional phase. Disney Plus, Prime Video, Max, and others offer comparable, sometimes bundled content at aggressive price points. Global penetration is maturing. In saturated regions like North America and Western Europe, net additions increasingly depend on poaching competitors' subscribers or reducing churn. Netflix's solution, an ad tier and a crackdown on password sharing, both have merit but introduce new risks. Ad tiers may cannibalize full-price subscriptions, and the password crackdown might backfire in churn. Meanwhile, content spend remains elevated with mixed returns. In short, Netflix is trying to reignite growth in an environment structurally less conducive to it. To be fair, not everyone sees doom in Q1. Bulls argue the miss is macro-driven. Inflationary pressures and economic uncertainty have dampened discretionary spending. They point to international markets where growth continues and suggest the ad tier rollout is still in the early innings. Moreover, Netflix retains a strong strategic moat. Its content engine, global distribution, and brand remain formidable. Bulls highlight its operational discipline. Unlike competitors, it generates free cash flow and controls its own destiny without burning capital. These arguments matter, but they don't fully negate the valuation reset triggered by the miss. The issue isn't just about missing a quarter, it's about challenging the trajectory embedded in market models. Netflix's stumble offers broader lessons. First, it underscores the importance of aligning KPIs with financial outcomes. A user isn't valuable unless they contribute to margin or monetization. Second, it shows the sensitivity of DCF models to long-term assumptions and the perils of optimism unmoored from evidence. More importantly, it reveals the fragility of narrative-driven investing. When models are built to reflect stories rather than fundamentals, even minor disappointments can cause major dislocations. For analysts, the task is to stress test assumptions, calibrate base rates, and look beyond the metrics the company wants us to see. Netflix's Q1 subscriber miss was more than a data point, it was a narrative rupture. It reminded investors that growth is not linear, that KPIs must translate into cash flows, and that market optimism can evaporate quickly when expectations aren't met. For portfolio managers and analysts, this episode is a call for greater rigor in modeling, skepticism in narrative adoption, and humility in forecasting. As the streaming industry matures and investor focus shifts from growth to sustainability, Netflix may well adapt. But its stumble has already reshaped how the market views and values growth.